This week, you covered margin, the textbook version with Pete. That was fantastic. And I'd like to start today. We're going to get a little bit more practical with it, draw some analogies to options trading with futures margin here. But let's kick it off by you recapping maybe what you guys covered and where you stand in terms of futures margin in a moment.
Dude, we're on the same wavelength because I was actually going to do that. I'll say I'll have 3 takeaways from when I talked to Pete the other day. I got them written down here. So one is margin increases with volatility. Mm-hmm. The idea that the calculation that we use is span margin, that calculation right there. So did a little look up on that and trying to get more understanding on span margin calculation, which, again, I want everybody to understand, like, I feel it's not just on you guys to bring stuff to me. I try and learn a little bit on my own, like on my own. That's old
my gosh. Keep going. Keep going. Keep going. Let's go. Let's get to the first.
I know Frank is on the old songs because you do a good job of collecting some records. I figured you'd be on that. We got to hang out and listen to your records and sip some mint julep or something like that.
Oh my gosh. I just got a great double LP, a best of Otis Redding. Picked it up from the Dusty Groove just a couple blocks away. You come over after we're both vaccinated. We'll sip some mint juleps. We'll put on the Otis Redding. We'll hang out. But anyways, sorry.
Span margin increase with volatility, and then does that position fit inside your portfolio? So I think those are the 3 big takeaways that I got the other day. So with that said, again, we're moving forward today. What we got here on the slide, futures margin is the amount you must post to buy or sell an asset, which is usually less than the stock version. And as we kind of mentioned the other day, and we're going through again, most of the time it can be like 50% for stock or ETFs. In case of small futures, anywhere from 1 to 50%.
Absolutely. Great takeaways there. And I'm so happy to hear you're doing the independent research. And the span research in particular is one of those things that is really helpful and intriguing. But at the end of the day, especially after you get through the content that we're putting up here on The Leap, it's hopefully like the first and only time you need to look at it. Because to trade futures, and I think you got this, Jermal, like, you don't need to be a span scientist to trade futures, but it's great to look up a white paper on it, understand what it means. You had very great takeaways right there already. Like, volatility increases, boom, margin's going to increase. Volatility falls off, the markets get boring, boom, margin's going to decrease. And at the end of the day, that margin is just the amount that you have to post to buy or sell. And it's usually less than that of the stock market. And we went in with an example here in the FX world, which is where this is extremely relevant, because foreign exchange, traditionally one of the lowest volatility markets. And this is where futures get really intriguing for me, Jermal. And I want to get your feel on this as well. When you have a stock or an ETF version of foreign exchange, FXE, UUP, those ETFs that track the euro and the US dollar, when you're static at 50% margining and that market gets down to right now sitting around like 4 or 5% implied volatility, you're going to get real small movements for a large price tag. What's really nice is the dynamic nature here that you can speak to in a second, bringing you down to just 1.3% currently capital requirement for a futures version that we're looking at, the small US dollar.
Yeah, I mean, that's actually pretty dope with what you just did, because it really makes you think about the risk reward. Because like you said, I mean, I'm aware of those stocks that track the currency, never traded them because of that exact reason what you just said. And so this and it's always been, to me, it's always been like, if I'm going to trade currencies, I'm just going to actually try and trade currencies, which, is a tall task in itself. Or this right here is really a lot more interesting to me because of the risk reward. I mean, I like, 1.3% that you're using with something that has a notional value of 14.5. I like that.
Yeah, absolutely. And this dynamic nature leads to, like I said, I can't say 100% of the time it's always more efficient with your capital, because you do have an interesting case, which I don't want to get to today, but we will get to down the line, where you have like a Bitcoin market, for instance. The futures on that market, a very volatile market, might actually be at or above 50% just because that market doubles, excuse me, or is cut in half every month, it seems. So this is the opposite side of the spectrum where futures margin really comes into help. Because Jermal, you passed up UUP and FXC after looking at it for a couple of seconds, I'm sure, because you're like, damn thing moves a penny, like moves 2 pennies. How do you find opportunity around that? What's really nice is you can go to something like the small US dollar and see a lower volatility, 4 or 5%, where you're used to 20, 30% in the S&P or other equity indices. And you can still, since the margin is so efficient, you can get nice returns like you were talking about. But let's move on to today's topic, which is tying that margin in with how a lot of people use options.
Thinking cap on. Thinking cap on. You know what I mean? Like how Tom does.
This is amazing. Look at this guy. He sings. He's got the props and the jokes. Holy hell. We've got ourselves a star on our hands, everyone. Jermal, I love the thinking cap. And hopefully you can crunch a couple of these numbers for us. I put it out there, and you've traded options a ton. And I just like continuing this thread that we started last week, which is likening futures to a long call option. Why do a lot of people go to long call options? Well, to theoretically get some long exposure at a cheaper cost. And so you look at the fact that a long 10 delta call, Jermal, costs right now in SPY 32 cents or $32 relative to 10 shares of SPY being north of $2,000. You want that efficiency, right?
Yeah, I mean that's a whole lot easier to digest, I would say, overall. When you look at this, like, you don't have to think about the decay factor, because like you said, I mean, and this is a great example. If you're going to buy a 10 delta call, first of all, that's pretty far out of the money, and your chances on that, your potential for profit is pretty low. Whereas, and again, looking at this, like, then I think that you also did a great job here of talking about the margin for the shares. Like, if it's currently trading 400 or thereabouts, then you're only putting up 50%. So that's where the 2000 comes in. So I see where that makes sense. And so this is definitely, going about it this way with the long call is definitely a lower probability situation. And it's one that most of the time we wouldn't be really interested in entertaining.
Well, you nailed it. I hope everybody saw what Jermal just did there. Was like, you tied in exactly what futures, the middle ground that they straddle between like efficient but lower probability long options and inefficient but static exposure stock shares. Like, yes, I want the cheaper price tag with $32, but like Jermal said, that long 10 delta call, that's a 10% probability of that thing profiting. No one wants to lose 9 times out of 10. You add in the decay and everything else, you have to have a lot of things working for you for that long 10 delta call to go in your favor. So in essence, I'm getting the cheaper price tag, but am I just throwing away $32 to get more efficient exposure? Go over to the shares. I've got consistent exposure, 50-50 probability. So all I have to worry about is I'm buying the shares. Stocks need to move higher. They don't need to move higher by a certain extent. I'm at 50-50 as opposed to 10-90 where I don't want to be. But now my price tag has grown to $2,000. Futures, they're right there in the middle. They take the pros of both of those, which is smaller, more efficient price tag for exposure and static exposure there that doesn't, like, this is the April 16 call, Jermal. Expires next Friday. What happens if SPY is unchanged going into Wednesday or Thursday of next week and then moves higher by $1? I'm probably still out that money, right?
Oh, yeah. Yeah. You're still out of that money from a little thing that we call theta. It's just zapping that. So, that's probably, there's a good chance that expires worthless.
Yeah. So
we've done it. I've done it many a times.
I feel like it's honestly like it's a good first journey into, like, the SFX futures, good first journey into futures and foreign exchange, because margin is low. It's low volatility. It's not going to really whip against you hundreds or thousands of dollars on a given day. So it's a nice place to dip your toe. Same with the long options. I feel like that's where a lot of people cut their teeth in options, but you quickly learn, like, hey, I keep buying these out of the money options because they're cheap, but I don't win on any of them. It's like you're taking these flyers that rarely cash in, and they bleed you over time. And that's why futures do present this nice middle ground here. And hopefully you can kind of take us home here with the more practical conclusion with a nice little graphic just showing you the percentage returns of technology stocks that are margined at 100%, and you see, oh, they were up 14%. They came back to unchanged. Now my position would be up about 6 or 7% versus what futures efficient margining can get you, which is just higher returns. But why don't you take us home here, Jermal?
Nice. So we have futures margin is an efficient measure of potential risk and reward that can result in larger returns. And so, as you see, we have here on the right, we have stocks, right? So we have technology stocks, like you said, earlier in the year, at February, we're up 14%, but now in a situation where we're up 6%. So this is that comparison here we're looking at. Left we have stocks, and then on the right we have the technology futures from the small exchange. Is that what's going on?
Mm-hmm. Yep.
Okay. Yeah. I mean, this is an interesting comparison looking at the two. And so, at the end of the day, from what I can understand, on the right, because of our margin, because of that higher return on capital, we see a huge difference between the two when we look at stocks versus futures.
Yeah, it's a matter of getting like the same opportunity. Like futures don't create like some new wild asset. Like when you're trading tech stock futures, it's not like you're trading something that moves wildly different than Apple, Microsoft, Amazon and everything else. But what you are afforded is larger potential for returns, larger potential for losses, of course. Like this could swing against you, absolutely. But the small exchange at least hones that in with smaller products, as we're so named, so that you can, get in there and trade tech stocks without having to put up 50 or 100%. And I mean, some of those tech stocks, this, Jermal, like Amazon, who can even foot one share of that at this point? You get in there for tech stocks, and it's a market in the futures world that costs you just a couple of $100 to get a whole mess of exposure. And so I think it's, at the end of the day, just a more efficient price tag.